Most people think stocks go up because the company is good, but that's not precise enough. A great company can have a falling stock, and an average company can suddenly soar. So what actually pushes a stock price higher? In this video, I'll show you the real drivers behind rising stock prices in a simple way, but without the usual fake guru nonsense. Because once you understand this, you stop looking at the market emotionally and start seeing the actual mechanics behind price moves. Before we talk about why stocks rise, we need one important idea. A stock price is not just a reflection of the present, it's a reflection of what investors believe about the future. That means stocks don't move only because business results were good. They move when the future looks better than it looked before. That is a huge difference. The market is constantly asking, will this company earn more money in the future? Will it become safer? Will growth accelerate? Will margins improve? And is this business now worth paying a higher multiple for? So if you want the cleanest answer to why stocks go up, it's this. Stocks rise when expected future value goes up. And that usually happens through a few very specific channels. The first and most fundamental driver is simple. The company earns more money. If revenue grows, if margins improve, if net income rises, if earnings per share, EPS, go higher, then the value of the business usually rises too. A very simple framework is this. Stock price equals EPS times price to earnings multiple. Let's say a company earns $5 per share, and the market values it at 20 times earnings. That gives you a stock price of $100. Now imagine EPS rises from 5 to 6, while the price to earnings stays the same at 20. Now the stock price becomes 120. Nothing magical happened. The business simply became more profitable. This is why, over the long term, the strongest stock performers are usually companies that can grow earnings consistently. Not hype, not excitement, not social media posts. Sustained earnings growth. Now here's where things get more interesting. Sometimes a stock rises even if profits don't improve much. Why? Because investors decide that the company deserves a higher valuation multiple. This is called multiple expansion. Using the same example, EPS stays at $5. But the market changes its view. Maybe the company is now seen as higher quality, more predictable, less risky, operating in a better industry, or having stronger long-term growth potential. So instead of paying 20 times earnings, investors are now willing to pay 25 times earnings. Now the stock goes from 100 to 125, even though the company earned exactly the same amount. That's powerful. And this is why stocks often re-rate upward when the market starts believing this business is better than we thought. So yes, profit growth matters, but perception of quality, durability, and future potential matters too. This is one of the most important lessons in investing. Stocks do not react only to absolute results. They react to the gap between expectations and reality. A company can report very good results, and the stock can still fall. Why? Because investors expected something even better. On the other hand, a company can release only decent numbers, but if expectations were very low, the stock may jump hard. So when stocks rise, it's often not just because earnings are growing. It's because future guidance improves, analysts raise forecasts, management becomes more confident, a new product cycle looks stronger, or the market realizes it was too pessimistic. This is why the market often feels irrational to beginners. But in reality, it's not always irrational. It's just forward-looking. And that means the stock is pricing tomorrow, not yesterday. Another very real, very measurable driver of stock appreciation is share buybacks. If a company repurchases its own shares, the number of shares outstanding goes down. And when that happens, earnings are divided among fewer shares. That pushes EPS higher, even if total net income stays unchanged. Example: a company earns $100 million. It has 100 million shares. EPS is $1. Now it buys back shares and reduces the count to 90 million. Same 100 million in profit, but now EPS rises to 1.11. That means each remaining share represents a larger piece of the business. This is why buybacks can support stock prices, especially when the company generates strong free cash flow and repurchases shares intelligently. Stocks can also rise when the business becomes less risky. For example, debt goes down, liquidity improves, the company survives a difficult period, legal issues disappear, cash flow becomes more stable, or interest rates fall, and investors demand a lower risk premium. In that situation, the market often says, "This company is safer now. We're willing to pay more for it." That can lift the valuation multiple, which again pushes the stock price higher. So rising stocks are not always about explosive growth. Sometimes they rise because uncertainty falls, and lower uncertainty can be extremely valuable. If you want one framework to remember from this whole video, make it this. Stocks rise mainly because of two things: earnings per share go up, or the market is willing to pay a higher multiple for those earnings. That's it. In simple form, price return approximately equals EPS growth plus change in valuation multiple. Then, on top of that, you can add buybacks, lower risk, improving expectations, and capital flows into the stock or sector. But the core engine remains the same: better business, better valuation, or both. And this is where many investors make a mistake. They think, this is a great company, so the stock must go up. Not necessarily. A great company can still be a bad stock if expectations are too high, if valuation is too expensive, or if growth starts slowing down. The market doesn't reward greatness alone. It rewards improving fundamentals, improving expectations, and price levels that still leave room for upside. That's why investing is not just about finding good companies. It's about finding cases where future reality may turn out better than current market expectations. That's where big stock moves often come from. So why do stocks go up? Not because people like them. Not because the company is famous. Not because headlines sound exciting. Stocks rise when the market sees more future value through higher earnings, better expectations, lower risk, smarter capital allocation, or higher valuation for the same business. That's the real game. If you want, in the next video, I can break this down even further and show you how to tell whether a stock is rising because of stronger fundamentals or just hype.